Okay, now you should see the screen. If you would have questions or something will not work, please speak, because I won't have the chat available all the time. Okay, finally we started. The topic we covered today is financing decisions. So far, we mostly discussed with you part related to investment decisions. Then we talked about capital budgeting, for example. But if you can recall what we started from, we said that there are two main types of decisions that firm makes, namely investment and financing decisions. And financing decisions, we mentioned that they are less important, but they must be done right. Otherwise, it might create the huge problems to the business. And that is why today we will discuss them. There are multiple things to keep in mind in order to understand where a company can get money from. And this is what we are going to discuss today. Today we cover quite a big amount of information that we would cover today. And please read the related part in the Braley-Myers book related to corporate financing. There is multiple chapters that include in this segment there. We start by discussing net present value calculations for financing decisions. We know how to do it for investment decisions, and the way we do it for financing decisions is pretty much similar, but there are some adjustments to be made and to keep in mind. Then we will introduce the way financial markets are organized, which institutions, how they work, what we need them for, and how the money flow on the market is organized from investors to the firms that are looking for an additional financing. Then from that part, as we talk about how firm attracts the money, then we naturally move to the area of pricing, because how much money firms can get depends on the evaluation of the firm. And then we should discuss how the theory and how the practice looks at the issues of corporate pricing of the equity. Then going from the equity, we also cover another opportunity for financing, namely debt financing. And finally, we will discuss the stages of the company life cycle and the different patterns on financing which are applicable for the firm at each of those stages. And so if, again, we keep on recalling earlier classes that we have, and now we're recalling the concept of net present value. And you should remember that then we talked that we discount at the opportunity cost of capital, and also they depend on the risk associated with the different types of financing. And depending on the discount rate, the value of different assets can change dramatically. And what we can do the same thing for the financing decisions. The only difference would be is then we talk about investment decisions. First, there are some investments, so there are some cash outflows. We purchase something, we can purchase building, we can purchase machinery, we can invest in the salary, and so on. So we spend some money hoping to receive them back as cash inflows. So in investment decisions, first there are cash outflows, then we hope to get cash inflows, and there should be cash inflows. Talking about financing decisions, the logic and the sequence is the opposite one. So we talk about the ways firm attracts money, and that is why we start from the cash inflow. So how we get money. We can get money as a loan, we can get money as equity financing. So first we get some money and then we pay them back. This would be the difference, and let's consider this difference using the example. One of the ways national states supports the firms is by providing them loans at the lower rates. And this opportunity to receive the loan at the lower rates, it has its own value that we are about to estimate. In Russia, in St. Petersburg, and in other cities, we have, for example, it's called Corporation MSP, so малое and среднее предпринимательство. So there are special vehicles created by the states in order to provide financing for the companies at the lower rates. Also, there are some opportunities to receive financing at the lower interest rate. Usually this opportunity is available to the industrial firms, so any other firms which are prioritized by the state. It's agriculture usually have these options, and depending on the region, it is the way regulators stimulate the it is the way regulators stimulate different industries within their region. And instead of giving them money, they can borrow the money. But the difference would be that they would borrow the money at the lower rates that are currently available on the market, and having the opportunity to receive money at the lower rates has its own value, and this is what we mean by the value of the financing decisions. The principal scheme is presented here. So the amount that we borrowed, because first, so when we borrow money, first we receive money, then we pay them back. So present value of the all interest payments that we would make, and present value of the loan repayment. Depending on the loan structure, sometimes we pay body of the loan together with the interests. Sometimes we pay interest first, then we pay the principal amount at the end. In this case, we pay principal amount at the end. It's written here that prior to maturity, lender requires only interest payments. It means that principal amount is paid at the end. So let's estimate. We receive $100,000 as a loan amount. So this is what we started from. Then for the 10 years, we pay 3% a year as an interest rate. And here it is 10 years. So this is the function of sum. 10 times we pay this. Each further payment is discount at a higher level. Why we discount at 10%? Because for us, it is an opportunity of capital, because we know, we have information in the exercise that the return on the equivalent risk project is 10%. So this is something, the rate at which we compare our project against to. Finally, we pay money back in 10 years period. And this is how we would estimate the NPV of this project, of the opportunity of having money at the lower rates. In this case, it would be 43,012. So again, the logic of estimating financing decision is the same. We just need to figure out the cash flows. The cash flows here are receiving the money, then interest payment, and then principal amount. Interest payment and principal amount can be compressed together, but the general logic will not change. And if in this case we would rate at the same rate as the market one at 10%, then NPV would be equal to 0. But if we have opportunity to attract money at the lower rate, then we would have additional value created by such a successful financing decision. Let's discuss now where money comes from when they go to the corporations. There are multiple sources of money where it can get from, and this is the principal scheme, this general scheme of the money flow on the financial markets. So there are people, including us, we make some money and we save them somewhere. We can either invest, open the deposit on the bank, or we can have an insurance policy, or we can invest money for the pension fund. So this is something everyone does according to the law. It is employer does this on our behalf, but this is in principle this is our money that are invested on our behalf by the pension funds. And this money, alternatively, investors themselves can invest directly on financial markets. For example, you can install brokerage app to purchase any type of securities. If you invest into financial intermediaries that I just mentioned, they themselves also would go to the financial market because they use your money to make some profit. And where all real profit, where all real growth come from, it goes from the business, from the real corporations. And that is why all financial intermediaries and financial markets, they are there to put their money into the corporations. And corporations themselves also need money for their operations, and they generate profit and then generate growth of the investment for this group. And this is where economic growth is coming from. Also, corporations themselves have their own profit. So some profit goes to the financial market as a dividend or as interest payment, if we mean stock fixed income securities. But still there is some profit left, and this profit can be invested back to the corporation, and this is called reinvestment. The decision how much money to reinvest, how much money to pay out as a dividend is called reinvestment decision or plowback decision. So this is the decision when corporation decide which fractions of their income to reinvest and which fraction to pay out as a dividend. Here we have multiple examples how it can work. It can be banks, insurance companies, brokerage. So there is investor here. Investor invests in some intermediaries, so we can invest in funds. Funds or intermediaries put those money to the corporation. Corporation has obligation to intermediary. Intermediary has obligation to investors. We discuss here two examples. Probably the main ones. We have a bank, so you as a client of the bank can open the deposit there. You put money to the bank, bank brings money to the corporation, so they would purchase their equity. They can purchase their share. No, excuse me. In this case, not share. In this case, the bank would borrow money to the corporation, and corporation would pay interest to this institution, and using this interest, investor would receive money as interest on their deposit. That is why the interest payments on the deposits are always smaller than the interest payment on the loan, because this difference between interest on loan and interest on the deposit is a source of income for the banks. And that is why there always will be some margin. But still, investor themselves are also interested in it, because individual investor usually doesn't have enough money to invest in a bigger firm, or particularly to borrow money to it, but the banks have this opportunity, and that is why this is mutually beneficial for all parties involved, if assuming that interests are stated fairly. Another option, it is an insurance company. You can purchase insurance policy from such company, then they would issue the debt themselves. The company would issue the debt, insurance company would purchase this issue and sell the policy to investor, and again, this is where the profit will be generated, and the insurance company would have some profit here, an investor would have some profit, and the firm would have money to use in their main business. Do you want to say something? It's good. Okay. So the role of financial markets and intermediaries are quite an important one, but no, it is. Let's first discuss it, then I can provide some additional thoughts on that. Financial intermediaries like banks, insurance companies, pension funds, they are important as a mediation and payment mechanism. They can accumulate money from multiple investors. It can be millions of investors, and having such a big amount of money opens for them opportunity to invest better, to have higher return on their investments. And that is why it can be good for individual investors as well, because through this intermediary, they receive opportunity to invest into the better project and have better return themselves. Also, this mechanism. In Russia, the main role would be played by banks, and banks is where you can safely invest the money. You know that amounts up to 1,400,000 are secured by the state. Even if the bank default, you will get your money back, including the interest payment, and the bank themselves would make money on giving loans to other people or to corporation, and this is how the market money flow is working. So they accumulate money and they find those who need those money, and for these services they charge their own margin there. Recently, the modern technologies like brokerage technologies or peer-to-peer financing, they are getting more and more important, and the role of intermediaries are going down, but still so far it is huge. And also why they would remain important, even if the technologically we would have opportunity to have peer-to-peer financing, the important things that banks, they can be regulated. They are very transparent to the regulators. State knows where money comes from, where they go, so they can prevent any illegal activities there. And that is why all new sources of financing, for example, recently I saw the suggestion of the Ministry of Finance in Russia, how they suggest to organize legally cryptocurrency market. They suggest to organize it through the banks. Why? Because they want to know where money comes from, where they go, and this is you can do it only using the banks. And my point here is, even if technologically the role of financial intermediaries might get less important, eventually they still always be there because they are important for the regulators, and regulators have their tools in order to support intermediaries and to make them important and necessary for everybody. Okay, so as we discussed how the money flow within the economy, now let's discuss how we determine the prices. So if we talk about the loan, it's more or less clear, but still, when the loan is issued, the price of the loan might change. And if we talk about the price of the corporation, it is even less clear how to determine it. But there are some general ideas to keep in mind, and this is what we are going to discuss now. There was a long tradition of econometricians and other scientists who were trying to predict the changes in stock market prices. And they tried to predict, do some auto-regression analysis, so trying to predict what would happen to the price next day, depending on the today's price movement. And in the middle of the 20th century, it was statistically proven that daily or more frequent price movements, they are random. There is no strict pattern there, and you cannot predict next change using previous change. We can, as we have this chart in the beginning of the course. If we draw the stock market price, stock market value over 100 years, so other reasonably long period, we will see that the tendency of the stock prices is that they would go up. And modeling it, we would also have random game here, but slightly skewed up. So the chances of increase, the value that we receive on the upper part, on the beta part, slightly higher than the amount that we lose if we will not guess. And what we have here, we can play this coin game. If we guess, we receive additionally $3. We receive additionally 3%. And if we do not guess, we lose 2.5%. And we can play this game in order to model the price movement. And here, to illustrate it, we have one line is this coin toss game at the rules that we just mentioned, and another one is 5 years of Standard & Poor's 500 index price movements. And it is impossible to guess where we have a random coin toss game and where we have actual historical data on the price movements. So you might try to guess. This one looks more like the actual price movement, but actually this was a coin toss game, and this was an actual change in price. So if now we can model these random changes, we can model them and we can compare them with the actual data. We will see that at the smaller frequency data, the actual results will be pretty close to the random one. Another way we can support this idea of the randomness of the stock prices is by drawing such kind of charts that you see now on the slides. On the x-axis, this line and this, we have return on the day today, on the day t, and on the y-axis would have return on the next day, t plus 1. And if for example, the dot happens to be in this quadrant, it means that if today we have positive return, next day we also more likely to have positive return. Here in this quadrant, the situation would be the opposite. Here would be the idea if that today we have a positive return, tomorrow we have negative return. And here would be vice versa. And you can see it, you can make this game yourself by any actual stock price. Doing first homework, you collected this data, and using some not that sophisticated statistical software, you can plot such chart yourself. And you will see that you will have some kind of the same chart. The correlation coefficient here are insignificant. They are very low. They both below 10%. So it means that practically there is no correlation there. And if there is any trend identified, then the problem is that once this trend is identified, the money flow on the market are now so rapid that very fast all investors would go for this opportunity, and the price of the asset will adjust accordingly very, very, very fast. And that is why the opportunity to use some arbitrage is very, very much limited. And this idea of pure randomness of the stock prices, and in other words, we can put it is that it is impossible to outperform the market because the market includes all the data available. So this idea of the price randomness is very much connected to the idea of the information flow. So whether you have the same data as all other investors, and the situation and the way information is distributed is called the market efficiency. So the more even information is distributed, the more efficient market. And this theory was suggested by the Eugene Fama, 1970s, and there are different forms of market efficiency, because we can put this idea that everyone has the same information which is presented in the price. We can put them in a different form, so make this statement stronger or weaker. And here we have these three options presented on the slide. The weaker form of market efficiency we put it in that way, that market prices reflect all historical information. Putting it to this absolute, to the ultimate destination of this idea would be is that we cannot use any technical analysis to predict the stock price, as all historical data, historical price movements are already reflected into the price, and we cannot anyhow predict the price to estimate that it should change. The second form, the semi-strong form of market efficiency theory, would be that market prices reflect all publicly available information. So here we would talk about all annual reports, all the statements which are public related to the firm, so all the news, everything. So if it is known by one person, it is known by all investors, and it is already in the price. And the final form of the statement would be strong form of market efficiency. It means that all information is already into the price, so all the smart analysts, they already incorporate this in their model, and there is no way to outperform the market, to find any inconsistency there. But the good news, so this theory, we can use it as a starting point, because empirical studies on the market have quite a strong evidence on the cases when information flows seem to be not efficient. So how it is works? So we have a model, idealistic model that would start from regarding the distribution of the information, and then using some estimations, we would check whether this theory works, or how, or when the actual data deviates from it. We would, when we talk about the market efficiency, we use such estimations that are now presented on the slide. The adjusted stock return is return on the stock minus return on the index. What we mean here is that index is a market average, which consists of all the stocks there, and everything, the part of the price movement which is different from the change of the average market, is some specific risks associated with the firm, and they might be related to the abnormal information flow. Expected return, how we would estimate that? We would have a alpha plus some beta coefficient and return on the market index. So this is something that we start from. This is model C, is similar to the CPM, but it is even more simplistic here, because instead of premium, we go directly with return on the market, and this is something that we expect to have as a return. So something that we predict using the historical data on the returns, how the return on the market are correlated with the return of the stock. And the difference between actual return and expected return is called abnormal return. And this is a way to estimate the effect of the firm-specific information on the price. So here is an example of the firm-specific information. Recently, like 2 weeks ago, there was this case took place with Activision Blizzard firm. There is this each dot present cumulative return of the stock, and people expect some announcement to be made. It can be it works well with the announcement of the merging deal. So then the firm will be acquired by another firm. And there are some rumors that it might happen. Then there is a date of announcement, and usually the firms are acquired at the higher price than the current market price. And in that moment, the price would surge, price would jump upper. Then it should stabilize at this new level. So as the information here, there were some rumors, it were not publicly available, and once it's completely disclosed, then it is available to everyone, and this is already in the price, and price getting stable on this level. Recently, Activision Blizzard were acquired by the Microsoft firm, and we had the similar dynamics in stock price. That so this is concerned with the information flow. Once it's got public, it's immediately incorporated in price, and after that the price reaches new level, and you cannot use this opportunity anymore because it is already in the price. There are some groups of business that tries to benefit from expertise of using some additional data, of using additional models, and here they are called actively traded funds. And here there is a historical data of the return of actively traded hedge funds and the general index of 5,000 companies, full share 5,000. And you see that actively traded funds, they not always perform better than the market average. Quite frequently they perform even lows, because actively traded funds, they should choose the best stocks. Then they should have their own commission, because their services are not cheap. They should put a lot of effort there, and they charge substantial money for it. So they should be better than average plus their commission, and this is not that easy compared with a just average of 5,000. And what takeaway we would have from this slide is that it is not easy to guess where price would go, and to use the information in order to outperform the market. This is even professionals frequently fail there. But still there are this problem of identifying anomalies, identifying the ways situation deviates from efficiency on the financial markets, is quite useful and interesting exercises. It all goes to the behavioral finance. Now scientists go further. Instead of studying on the behavior, there are some neurofinance, when people try to mechanically check some impulses within our brain associated with different decisions. And there are some well-known anomalies from efficient behavior and efficient information flow, which were detected, and I want to briefly introduce them to you. And in your research works, you're very welcome to try to study behavioral aspects of finance. For that, you should know the basic theory well related to market efficiency, but then, because all behavioral finance are study of deviation from the market efficiency, and in that sense, it's important to know it. And this is quite interesting because it is related to psychology, to human behavior, and everything human related is quite fascinating. Several well-documented anomalies in human behavior related to finance that we can introduce. There is one is called the loss aversion, is the principle that other things equal, the losses of some amount hurts stronger than the pleasure we get from having this amount. So, for example, if we would play the game, we can have an example. So, you have two options: to receive 250 rubles guaranteed, or you can play the game having 30% chance to win 1000 and 70% chance of win nothing. So by calculating the probabilities, something that we did with you last time talking about decision trees, the second option is better because the expected value there would be 300 compared to the guaranteed 200. But those potential of loss, the potential of losing 700, will nudge people to vote for this safe 500 or safe 250. Yes, so other things equal, you can try to put it on yourself, compare where emotion would be stronger if you accidentally lose some amount of money or when you find the same amount of money. The evidence are that this emotional effect is stronger at the losses. So as an output on the financial markets, that people frequently afraid losses so much that they even can decline lucrative opportunities there that might be offered if they take some risk. Another very interesting behavioral pattern, which is identified in financial related behavior of the students and of the corporation. It's called the mental accounting, and it means the following. Even though the money are uniformal, so all money, regardless of where they come from, by their nature, they can be invested anywhere. They do not have any feature of the what they should be used on. But it is identified that people always have differentiation between the money depending on where those money came from. If you accidentally had some huge money, so you win the lottery or you had unexpected bonus at work, then you are way more likely to play some risky activities on that money because you didn't expect them and you are more open to more risky ventures with them. Alternatively, if there are some money that you put for retirement or put for vacation or for shopping, you would be less likely to risk them. Of course, there are some individual preferences and people are different in terms of their risk appetite, but still even them, no, even the most risky people, they also usually differentiate among the money that they have, and depending on the way they plan to spend their money on, they would demonstrate different behavior with this money in terms of the risk. Also, there is if the situation were so there are different patterns in people's expectation. This blue line here presents the bearish sentiment. So the fraction of people that expect market to go down compared with the actual return. And you see that people expectations, for example, here, they are behind. So when the market actually started to go down, like it was here, there were less than half of people expected it to go down. Once the market reached its bottom, so when the market had some time to go lower, people started to expect the market to go down, but in that time they would be better off expecting the opposite. So people are very much impressed with the recent events, and they occupy the main part of their attention, and they tend to make their decisions on the most recent information, even though strategically it might be misleading. So this is something related to the behavioral financing. Now let's discuss how the work is organized in terms of the attracting financing, how this process is managed within the firm and who manages it. As you know, there are chief executive officer, so the head of the firm, of operational firm, but strategic decisions, they are made by the board of directors, and the board of directors, they can be elected using different procedures. The board of directors, usually they are re-elected yearly, but there might be some adjustment in this procedure might be introduced. So, for example, the board of directors can be classified, and one class of directors might be re-elected yearly. Other class of board of directors might be re-elected less frequently, or they can have different schedules of re-election, and so on. The procedure might be different. The majority voting, it is then shareholders vote with their by the majority. So they have some candidates, and they choose for each of them. They vote either whether they support him or not. And with the cumulative voting, I believe we would have an example here. Yes, there is an example here. It is easier to explain it with that. Let's say there are 5 directors to be chosen. There are 100 shares which vote. Under the majority voting, each shareholder in your being shareholder, you would receive the voting form in which you can vote for each share either for or against this director. Under the cumulative voting, the procedure would be different. Having one share, you would have 5 votes, which you can distribute among the candidates. So what you can do, you can cast all 5 votes that you have. You can cast it for a single candidate, having 0 for all the rest. And then those who would be top candidates by the total number of votes would be elected. But no, under cumulative voting, you have opportunity to support your candidate stronger. So cumulative voting is usually more attractive for minority voting, because under this pattern, minor shareholders have more tools to support their candidate. Supermajority voting is setting additional threshold for the decision. So we can say that, and we would write it in the article of incorporation of the firm, that we elect only those directors who received more than 75% of the share, not majority, but more than majority, 3/4 of the shares. So there are different sources. So once the board of directors is established, the firm can choose how to attract money. And there are two main sources. The first choice the firm would make is the plowback decision. So whether to plow money back or to pay them out as a dividend. If firm has good opportunities within its current operations, it's better to reinvest money. If not, it's better to pay them out as a dividend. And if firm looking for external financing, the board of directors and managers, they should decide whether they use equity financing or debt financing, so how they would attract money. This is the example of the balance sheet of the firm. This is aggregated balance sheet of the United States companies, and we will use it to show some ratios which are introduced in order to estimate financing structure of the firm. The one classical ratio is a share of debt to total assets. Let's take a look how it is estimated. We have current liabilities, so we have what we should do, we should estimate the total debt. We would have the current liabilities, we would have the long-term liabilities. So what we have, this one and this one, and we divide it on the total asset. Here it is. The higher this fraction would be, the more firm depends on the debt. Second estimation that firm makes, it is also important to know the time pattern of your debt. The longer I wanted to say the longer the better, but it is not the truth. So depending on the business cycle of the firm, the term structure should be done accordingly with the term structure of the business operation. So if the business cycle of the firm is shorter, then it's better to have shorter term liabilities. If the business cycle is longer, then it's better to have longer terms. Like retail business should have lower terms financing. If they use debt financing for their operation, they should have shorter term compared to the some nuclear plant constructing companies. And still, we can be interested in the fraction on the longer term liabilities to the longer term plus equity, because we exclude short term financing here, as we interest in longer term liabilities. The longer it gets, the more similar it becomes to the equity, as the payments that we should make here are further in the future. And this is one of the estimates that is there to say how strongly firm depends on the longer term liabilities in their financing systems. What is important to keep in mind is that depending on the way you provide financing to the firm, you have different rights over these firms. The shareholders, they have right to control the firm, and they participate in the voting, and they have rights, and they have control over investment and financing decision. The lenders, they do not have an option to participate in the voting, but as an upside, they have priorities in receiving the cash flow. So they have lower opportunities to control the firm, but they have more opportunities to control its cash flows in the fraction which is eligible to them. When we talk about the debt, there are some things to keep in mind. There are some particular risks associated with it. The one risk is known as a default risk. When you borrow money to the firm, what can happen? The firm can decline their obligation to pay you money back. It can be voluntarily or involuntarily, depending on the situation. If it's voluntarily, then you're eligible to take the assets of the firm. If it's involuntarily, you're also eligible to take them, but it might be that there is nothing to take or very little to take. And such cases are usually settled on the court. And in order to estimate how likely firm to go default, there are special firms doing that. They called rating agencies, and they issue the estimation of the risk of the firm in terms of the default. How likely the firm to go default? Here it is. This is the schedule. This is a scale of the default ratings for three most famous global rating agencies. The AAA is the best case. The C and D, it is close to default. D is default. C is almost default. And the better the rating, the less likely firm to go bankrupt. The less would be coupon payment that firm has to pay for having the financing. What we have here. Yes, and another important thing that we have to mention talking about the debt. So we started from the premise that we make a decision where to get financing from, debt on equity. Debt or equity. And what is important is that debt is tax deductible. The more debt we have, the more interest we pay, the less tax would remain. And this is technically the way state stimulates companies to have more debt compared to the dividend, because dividend paid from the net profit and interest paid from the income. So the higher the interest, the less profit before taxes, the less taxes we pay. And in that sense, this tax deductibility is something that we should keep in mind making the decision on the financing structure of the corporation. Yes, so making the decision on the debt, there are some things to consider, some issues to solve talking about it. The term structure, the way we set the interest payment, the currency that we use, the promises that we would make, and whether we should offer additional option to convert the bonds into the shares of the firm that we call convertible bonds. The main principle here that is very helpful to answer all of those questions is that financing structure should reflect the operational structure of the firm. So if we have an income in rubles, we should borrow money in rubles to mitigate currency exchange risk. If we have short operational cycle, it's better to have a shorter term borrowing structure to have the money available to pay back at the time then we need them, and so on. So what promises also depending on the particular type of business, we can make additional promises, we can adjust the loan agreement accordingly. Also, in terms of the financing patterns of the debt financing, we should keep in mind that we do not have to borrow money from the bank or issue the bonds to borrow money. There are some hidden or not so hidden forms of borrowing. The most simple one is accounts payable. So, for example, you received some goods, haven't paid for them. Actually, it means that your supplier lent you the money. Or, no, it is usually short term, but it can be 90 days or even longer. And this might be quite helpful for you if you negotiate good conditions. So for example, you might negotiate advanced payment from your customer and payment 90 days later with your supplier, and you can immediately start the business without any initial investment. So working with this part, working with the agreements you have with your counterparts might provide you the sources of hidden debt that you can use. Leasing is a particular type of debt which is there in order to finance the purchasing of different equipment and so on. So this is usually done not by banks but by leasing firms, and but effectively it is very similar to the debt, as you have some, for example, car or machinery, and you pay money back to the leasing firm for it. Not immediately, but in some longer period. Some kinds of unfunded obligations. So, for example, pension funds, you might promise your employees that you put money to the private pension fund, but you can do it later, and this would be also kind of debt. And also there are some special purpose entities, so you can issue special types of securities in order to finance your debt, and it can be used for shady activities as well, and using such things were one of the primary sources of the financial crisis. Now, final thing that we want to discuss today is related to the venture capital. So when we start the business, where we get the money from and how financing there would work. The financing at the early stages of the firm is called the venture capital financing or venture financing, and they are more risky, but as an upside, they potentially more lucrative. If you invest in the firm very early, it has very low valuation, and once it grows, once it matures, you have more. You have high chances to multiply your investment. But on the other hand, young new firms are more likely to go bankrupt. Let's consider the example. We have some firm, and what we start from, we should have some estimation of the firm value. And you invested 1 million initially, then some venture capitalist offer you 1 million more, and you gave to this person of this institution, you gave 50% shares for 1 million. It means that the estimation of your firm is 2 million in total, and you receive the cash from this new equity that you use in your operations, and this is how you attract the money for your activities. Sometimes passes, and next time hopefully the things go well, you expand, and you receive new offer to have equity financing from other investor, and they would offer you $4 million. But at this time, as the firm already expanded, the value of the firm instead of 2 got to 14, and this time 4 would be just how would be 1/3, something like 20, 25, 27% of the total equity. So those people who invested at this stage, so they invest 1 million, firm grew. Now this investment already worth 5 million. And you have some cash as 4 million, you have some fixed asset, and the big part in the asset side goes from the expectation. So other assets, they include intangible assets, that includes growth potential of your firm, and this part that is there because investors expect you to grow to get more profitable. Once the firm matures, you can go public, you can offer your stocks to the stock market, and this procedure of offering the stock to the stock market is called initial public offering. It is organized by the firm, usually those are investment banks. We call them underwriter. They purchase your securities and sell them to the public, or they can act as an intermediary. The difference between the purchase at which underwriter purchases your shares and sells them to the public is called spread. The presentation of the firm which is issued in order to attract investors for IPO is called the prospectus, and the risk and situation of offering shares for sale at too low a price is called underpricing. There are multiple reasons firm goes public. On average, it makes financing on the firm easier. It is good for the reputation. It helps firm to be more transparent, and it's also the way for initial investors to cash out from their investment. How we would estimate underwriter spread? Here is a very simple example. You sell 3 million shares at $40 each, and underwriter sells them at $43 each. The spread would be 9 million. There are different types of arrangement you might have with underwriting firm, either firm commitment or best offered commitment, or some. Also, there might be different arrangement on the costs associated with a public offering. I think it's a final example for today. You have firm commitment with the underwriter to go public, sell 250 shares at $40. There is 10% underwriter spread, and additionally, you will need to pay $600,000 legal fees. First, we would estimate, and we want to estimate how much money firm would actually receive. We know that we offer them to public at 40 per share, having 10% underwriter spread. We estimate that issuer would receive 36.36 per share. This is so the spread would be the difference between this and that for share. Issuer receives this amount multiplied by the total number of shares minus legal cost associated with it. Underpricing. So this is a situation then actual price were estimated wrongly, and if the price jumps too fast, it means that we should have offered stocks more expensive, and the estimation of underpricing presented on the chart. So here we have estimation of the underpricing. You see that there is sometimes underpricing, but no, mostly it is not too high. Final thing for today is that you can sell the shares at the subsequent rounds. You can sell them not to the general public, but you can first offer them to your current stockholders. And usually they are offered at the lower price than the market, or then it would be to the public, and this is additional value that might be received by the shareholders, and the way to estimate this value is presented on the slide. Good. I think we can stop here. Any questions? No? Okay, then thank you for being here today, and we see you next week.
Thank you.
Goodbye.
Thank you. Goodbye.
Take care.
Thank you.
Bye. Thank you. Goodbye.
Bye.